just cover a few things from last time and then we will continue. So last time, actually, one of the things that we saw was the South Sea bubble, uh, where Sir Isaac Newton, one of the great scientists, actually lost a lot of money. So we were looking at a slightly complex chart last time, but I think I found this chart which just helps us understand the principles in a much easier way. So basically, in the South Sea bubble, I mean, and this holds true for all bubbles, right? At the start of the bubble, Isaac Newton invested a little bit. And then when the stock went up to a certain extent, he exited. He was quite happy. He had made a good amount of gains. But then what happened? His friends kept their money in the stock and the stock kept going up. Hello, can we all please go on mute? So his friends also invested, and they had not pulled out their money, and the stock kept going up and up and up. And because he saw all his friends and all the people he knew keep getting rich while he had already exited at a profit. So Sir Isaac Newton again entered when the stock was at a very high level. And then what happened? The stock crashed. And so Sir Isaac Newton, who had actually made a good profit over here, ended up making a very significant loss over here. Now, this typically happens in almost all bubbles. We looked at the 2001 tech IT bubble, internet stock bubble, and that also had the same shape. And typically what happens is people generally, at least lay people, right? Lay people tend to invest somewhere near the top. So they'll find, oh, friend X of mine, friend Y of mine, that person, this person, he made 5 times return, he made 10 times return, he made 15 times return. How can I lose out? You know, and so this for the stock to have made a 10-time return, the person would have invested somewhere over here and the stock would have come up somewhere over here. Right. And then that person has made a 10-time return in that bubble. So, but people generally they say, oh, that person has made so much money. Now even I want to make money. And then they will typically enter somewhere near the top. Right. And then the bubble will crash and they typically tend to lose money. And that is the main principle we have to understand. So if we find a situation where someone is making ridiculous amounts of money in a stock and the stock has gone up, or a set of stocks are going up, then we should not get greedy. We should be very cautious, especially when the stock has gone up. We should look at various factors. We'll talk about those factors such as valuation and other things. And then we should take a decision. If we end up taking an emotional decision, then what happens is that we will typically end up investing somewhere at the top and then we will end up losing money. So this is the main concept that we should always keep in mind whenever there is any bubble or whenever stocks go up ridiculously fast without any fundamental, increase in profits. So this is one of the key things that we were doing last time. Then the second thing that we were doing is we were looking at this function indicator called CAGR and a few other indicators here. We couldn't do that properly because we were late, but let's do one thing today. Today I will show you how the CAGR may be useful. So let's take the stock. We all have heard of the stock. This is Berkshire Hathaway, Warren Buffett stock. And let's take CAGR over a different periods of time. So we have data available from 79 actually, but he was investing even before that, significantly before that. But this is where we have data available. So let us start from here. So we start from somewhere here. Right. And then let's look at his stock up to around 1990, 89. OK. Now you see over here from say around 1979, let's make it simple. Let's say 1980 to 1990. Warren Buffett went at over 36% a year. That is what this number shows us. From 79 to 89, roughly 80 to 90, he went at 36% per year. OK. Now let's remove this. And now let's look at the same thing for the next 10 years approximately. Right. So I will use the same functionality. And then we start from somewhere. We had gone to somewhere over here. So let's approximately start from here. And then let's go till maybe 10 years. Let's say till around this point. Okay. So now you see the first 10 years he had made 36%. Now in the next around 10 years, he made 26%. So 36 became 26. Right. Now let's again look at the next, say, 10 years approximately. So we were around this period. So we'll start from here and then we'll go till somewhere here, maybe 2010. Okay. So we see from 2000 during this decade, he made around 3.8%. Of course, we have not recovered from the 2008 recession. So this is on the lower side. But let's, for the argument's sake, let's take a longer period. Let's say how much has he made till today? Okay, approximately. So we will again start here from around the same point, and then we will stretch it right up to this place, up to today's amount. And you see, he has actually gone at 9.3% from the year approximately 2000 until today. So what does the data show us? The data clearly shows us that for the first 10 years, from around 1980 to 1990, he went at about 36%. Right, let's note it down somewhere to make it easy for us. This is approximate. Okay, he went at 36.3 or something. It was approximately 36% per year from 1990 until 2000. Right. He went at approximately 26% per year. And then from 2000 till today, it was at 9.3% per year. So typically when we talk about the returns of Warren Buffett, we say, oh, he's gone at about 19.8% per year, or that is the kind of number that comes through, right? But we see here a very distinct set of qualities that when he was younger and he had a smaller asset size, he could accelerate it very, very fast. Even from 1990 to 2000, he could accelerate it fairly fast. And by the end of 2000, he was fairly rich. But say from 2000, by that time he was maybe, I don't know the exact age, but he was around in his 60s and so on. He was maybe 65 or 70 or something of that sort. So from that period on, right, until today, what has he been doing? He's primarily been preserving. He's got a certain asset. He's making sure he's going above the inflation rate. He's going at a good pace. Inflation in the US is lower than India. Inflation in US maybe 3% or something like that. It's lower than India. So he's still going a reasonably at a reasonable place greater than inflation. But you see that percentage has come much lower. Now, if you take stocks from 2000, let's take a stock from 2000, which is one of the stocks which has done very well, which is Amazon, right? Let me just remove this. So now if we see Amazon, a stock like Amazon, we see that Amazon itself has given, just one stock has given 17.3%, which is significantly more than what Warren Buffett has earned over this period of time, right? So he was mainly just preserving his capital, put it into good, stable companies, but he was not accelerating it at the pace at which he used to earlier. And if you look at this period, there were a number of tech stocks and certain other opportunities where he had not invested substantially. Yes, he had invested in Apple and some odd stocks, but he didn't, it was not as, what do I say? It was not as fast and as aggressive as his investments during the earlier years. Now, typically, when we talk about Warren Buffett and we talk about his books, they'll talk about his investing style. They'll say hold the stock forever. They'll say all sorts of things. But at least I don't know of any book that says, okay, during this period, he earned so much. During this period, his return was so much. During this period, his return was so much. And what was the difference in the investing style? Why did he earn faster, in his earlier years? What happened? Why did he slow down so much? I don't know of a book that talks about this specific topic in much detail. But then, because, and if we just read the books and then we'll say, okay, be fearful when others are greedy, be greedy when others are fearful, we'll understand all those things, right? But but the just looking at this kind of an indicator and using these indicators properly actually tells us some stories that we don't otherwise know, right? Like for example, this Berkshire Hathaway return. So that's why I was actually covering this indicator. So let's take the other indicator that we were looking at last time. So the other indicator that we were looking at was date and time range. So let's zoom in. Let's say we want to find the return of Asian Paints for last 10 years, approximately, right? So we'll start somewhere here. This is September 2000. No, it's 13. We have to go to 14. So we'll go somewhere here, right? September 14. And then we will come till here. So we start this somewhere here, September 2014, and then we will come till here, which is approximately till today, right? Now, if we look at the number over here, let me zoom out a little bit. Yeah. So the number here says 429.8%. So the stock, which was at approximately around 650, has come to 3,300. That is a little more than 5 times. So the gain is 429.58%. That's what it is telling us. And 120 bars is in approximately 10 years. So we can kind of look at, so using this and using this time range over here, we can make the graph, the bar chart, 1 month, 3 months, etc. We will be able to find out, okay, what has the stock return been over, say, 3 years, 5 years, 10 years, and so on, right? And we will get this very, very accurate data. We don't have to go to some, let's say, for example, tomorrow I want to find the return of Asian Paints for 7 years for whatever investing purposes, right? If I go to Google and then I say Asian Paints share price, Google will say 1 day, 5 day, 1 month, 6 month, 1 year, 5 year, and then max. Right. You don't know. If you want 3 years, you don't know. If you want 6 years, 7 years, you don't know. And so that is why I had introduced this functionality. So that way you will know, okay, this stock has actually given us so much. So let's say we want to compare, say, a certain sector versus a certain other sector. You take stock A from a certain sector. Let's say, for example, we've taken paints over here. And let's say we want to take a certain other sector. Let's say we want to take, our FMCG goods, right? Hindustan Unilever Limited. And then we have the same graph again, right? We will again start from 2014 September, which is approximately over here, 732. So then we start September approximately over here. And then we come all the way till over here. And so what does this tell us? This tells us that Hindustan Unilever Limited has given us approximately 300%, 301.98%. So the stock has gone up approximately by 4 times. Asian Paints has gone up by a little more than 5 times. But then let's look at, for example, some other company. Let's say we take Bajaj Finance. I'm not sure if it will have this period. Let's just take Bajaj Finance and see. Okay, they do have it. That's great. So 2014 is over here. And then we come to approximately September, which is over here roughly. And then we come all the way. Let's just adjust this. We come all the way till here, right? And so we see Bajaj Finance has actually given us 2,790, 2,797.58%. That is, the stock has gone up by approximately 29 times. So if you had bought Bajaj Finance at, say, if you had bought for a certain price, it would have gone up. Let's say you had bought Bajaj Finance for 10,000 rupees. That would have gone up by another 29 times, right? If you had bought 10,000 rupees, it would have gone up by approximately 29 times. Okay. So in this way, we are able to look at how each stock is performed, and we are able to pick time ranges according to our convenience. And that is the benefit of these two indicators that we were looking at last week. So I just thought I will give a slightly more practical idea. Last time we had just touched upon this, that this indicator is like this indicator is like this, but we just touched upon it so that we see how we can use it and how we can benefit from it. So any doubts on what we've done so far? This was a continuation from last time. So any doubts on these indicators? Okay, I think if we are good, then we'll continue. So from today onwards, we start with fundamental analysis. And fundamental analysis basically starts with what is known as the income statement. So when I had first started investing, I never used to bother about all these indicators, technical analysis, and I never cared about it. I thought, okay, the richest people in the world are the fundamental analysts, people like Warren Buffett and so on and so forth. In India, you look at Rakesh Jhunjhunwala ji and so on and so forth. So the richest people have always used fundamental analysis. So why should I even look at technical analysis? Let me start from this, right? And even today, I primarily rely only on fundamental analysis. I just use this to get some more information and to get some better entry and exit points as compared to not using any of these charts. So in fundamental analysis, the first thing that we typically start with is what is known as the income statement, right? So income statement, which is a profit and loss statement, it documents the company's revenues, expenses, and say profit or loss over a specific period, typically a quarter or over a year. So let's take a simple example. Let's say that we are running a hotel, uh, and we have we have raw materials, which are all the food items, and then we are converting those raw materials into finished goods, which is the finished food products that we give. And then we have, say, some salaries to be paid, and then we have certain other things like electricity charges. We have all the table, chair, the decor, and all those costs and other things. So we've invested a certain amount, and then we need to know, how have we made a profit or have we made a loss, right? So that is the income statement. So let's take a simpler example. Maybe that you find a stand, a stand where a person is just selling some thing like some lemon juice or some buttermilk or something during summer. So that person has nothing. He will have some plastic glasses, and then he will have the input material, which is in the case of lemon juice, some water, some lemon, some sugar, right? So there will be a certain input cost for the sugar, for the lemon, and all of that. A certain cost for those plastic cups, and then he will sell it at a certain price, and then there'll be a certain output that he will make. There'll be a certain amount he will make after selling. And then he has to say, okay, my input cost was X. So to be profitable, I have to make more than X, right? And if he can make more than X, then he can stay in business. As long as he can make more than X to take care of his living expenses. So let's say his input cost per day, just as an example, let's say his input costs per day. Let's take a very simple example. Let's say sugar, okay. Let's say lemon, and then let's say water is of no cost. We ignore it, and let's say he has plastic cups, just as an example. Okay, per day sugar costs rupees 100, lemon costs rupees 50. We don't want percentage. We just want a normal. Let me remove this and put it over here. Okay. Cost rupees 50. And then plastic cups cost rupees, let's say 20. And the total comes to 170. So we have this, right? Now he has sold, let's say per glass, he takes rupees 10 per glass, right? And he has sold some 30 glasses, just for argument's sake. Okay, he has sold 30 glasses. So total cost is rupees 170. Total sale is rupees 300. And he has made a profit of 130 rupees, right? Now, if the seller of this lemonade continues to make a profit, then he can take that profit and use it for his living expenses. He can use that for his food, his living expenses, and so on and so forth. But let's say this person makes a loss. Let's say today, for some reason, there is COVID, no one is coming out to drink lemonade or something, and he's only sold 5 glasses. So let's say he actually only made 50 rupee of sale. All this lemon and all is getting spoiled and so on. In that case, he ends up making a loss. Now, if this person ends up making a loss, it will be minus 120 approximately. So if this person ends up making a loss, then he cannot survive. So that is the most basic concept. And we are looking at this profit and this loss by the income statement. And I'm just trying to simplify things so that it's very clear to us. So before we actually go into the income statement table, let's just understand this a little conceptually, right? So we take this Apple, and Apple has a number of different products. Okay, so the products are, it has iPhones, it has MacBook, it has iPad, it has some watch, it has some AirPod, and so on. And then it has a lot of services. There is the App Store, there is some Apple TV, and so on and so forth, some music and whatever, right? So now this is the money that they are making. Okay, so this is the cost. This is the cost. So this products, all this product, iPhone, MacBook, iPad, watch, and all of this is the cost of the actual product. This is the cost of all these services. And then there are some other expenses to run the business and so on. So these are all those costs, right? But once they input these costs, they are actually able to sell it for this much bigger value. So for example, the total product cost is some 201.5 billion plus some 22.1 billion and plus all of this. But their actual sale is 394, right? So out of 394, only some 170 billion they are making a profit. So out of this 394 billion, iPhone, they are making so much money, 200 billion. MacBook, they are making so much money. iPad, they are making so much money. All these services, they are making some 78 billion. And these are the costs. So they are making this much of profit, right? Which is basically 170 billion of profit. Out of these, they have all the we'll look at all these operating expenses, but net profit after looking at all these expenses, taxation and other things, their net profit is basically this 99.8 billion. So what do we understand? We understand that there are these inputs in terms of whatever are the costs they have, right? And then there is this gray that represents the total revenue, the sale money that they earn, the money they earn from the sale. And then this sale money minus these inputs costs will give us the profitability. And that is the essential concept of an income statement. Okay. Now, income statements are typically compared to whatever they have made in the previous years. So and we will talk about that shortly. So here we see, okay, what is this? This revenue has gone up. So sales has gone up by 8% compared to last year, right? Out of that, let's say product sales has gone up only by 6%, but services sales has gone up by 14% and so on. So they compare a lot of things compared to the previous years to see how the business is doing, right? So this is a conceptual understanding of an income statement. We will actually look at the table of an income statement subsequently. But any questions on this? I didn't want to directly go to the terms. I just thought I will start with a logical, simple example, and then we'll just understand it in a slightly different way, conceptually, what something means. So as far as we looked at this person, there are input costs, right? All these input costs are over here in red. And then we have, I think someone just came. So these input costs are all in the red. And then we have the total sale. Let's just take the profitable scenario. We have the total sale, which is basically in the gray in this chart. And then we have this total profit, which is shown in this green. Okay, that is how that is how we should understand this. And now we will actually go to the income statement and understand what these terms actually mean as to how an income statement is calculated. So we have a hypothetical income statement and we are taking it only for some simple FMCG and so on. So banking, insurance and all are a little different. We'll cover that in some other discussion. But for today's purpose, we just want to understand the very, very basics. And therefore, we will be looking at what are the key parameters here. Right. So the first thing that we saw, let me pull this. Okay. So the first thing that we saw in our income statement was the revenue that we see over here. Revenue is what is the sales that we have done. Okay. So this is the sale that we have done. Now the next thing is cost of goods sold. Right. So this sugar, this person who's selling the sugar, he has made this much of sale. But his goods, sugar, lemon, plastic cups, etc., the cost of goods sold is the next thing that is typically listed. Right. And then sale minus cost of goods sold is known as the gross profit. And then we have all the operating expenses, right? So let's say if this sugar guy had, the sugar seller had some 3 people working under him, then he needs to pay the salary. If this person has some stall, right, some hotel stall or something, then he has to pay the electricity and so on and so forth, right? So we have a certain other expenses. We'll not go into the details because if we see this in different tools, they are handled a little differently. So we'll just generally understand the concept and that would be it. So if we look at the terms, let's just take a simple example. Right, if we look at the terms over here, the terms are slightly different, but the concepts are basically similar. So we'll look at an actual income statement after understanding the terminology first. So there will be some expenses and then there is something called depreciation. So what is depreciation? Let us say that there is a hotel, right? The hotel has tables and chairs. Now these tables and chairs were bought. This hotel was started in the year 2020, just for argument's sake. This hotel was started in the year 2020 and they bought some table and chairs, right? So in 2020, they spent, let us, for example, say 10 crore on these tables and chair, just as an example. Now, this table and chair has a finite life. This table and chair cannot be used forever. So there will be a finite expected life for each item. So let's say table and chair is expected to last for 10 years. Okay. Now, though this amount has been invested initially, but at the end of first year, how much is it worth? 2021, the table and chair is worth 9 crore. Okay. 1 crore is an expense. It's actually expensed, saying, okay, I have actually lost this much of money and this is how much this is worth. Then second year, like this, table and chair is now worth 8 crores, right? And so on, if we stretch this, there will come a point where it goes to 0 crore and then they have to actually buy a replacement table and chair on this year, right? So every year in their plant and machinery, they will deduct some expense depending on the lifetime, and depreciation, how to calculate depreciation and all can by itself be a big topic. but we'll not get into the details of that. All we should understand is depreciation is a cost that is, that is accounts for the fixed some of the goods that are used, machinery, plants, machinery, and those sort of things, right? They reduce in value every year. And therefore, we take a depreciation. That's a notional expense. So this is not a real expense. No one is actually spending this 100 crore over here. It's a notional expense saying that I have equipment and machinery worth, let's say, 1,000 crore. And this year, the value of that machinery will come down by 100 crore. So that is depreciation. So it may be the case, that there is no, see, typically in depreciation, this money is not lost. This money is not lost from the pocket. But I mean, in that given year, but this is an accounting that is used so that we can include all our machinery, plant, equipment, and other things in the calculation of a year by year profit or loss. So then once we deduct all this, so then we have cost of goods sold, which is 1,200, and then, 2,500 minus this, right? So this is nothing but gross profit is nothing but this minus this. Now, all these numbers are added. These selling expenses, administrative expenses, depreciation, and all are added. So this is this plus this plus this. Okay. That is your same total operating expense, which is 550. Now, how do we get the 750? This is earnings before interest and taxes. So how do we get this number? We basically subtract this operating expense from the gross profit. Okay, and we get 750. Now, usually most of the time, right, any business will have its core business. So for example, if you are buying, say, shampoos and soap from, say, Procter and Gamble, or if you are buying shampoo and soap from, say, Hindustan Unilever Limited, they will make most of their money from their revenue, from their production of their soap, their shampoo, their other products, and so on, and they will sell. But there can always be a small amount of other income they make, right? So for example, a company may have some excess cash left over from the previous years. So company has been operating for 20 years and then it has been making a lot of profit. It will have that excess cash. So maybe it may keep that cash, say, in some bank account. It may earn some interest in that cash, right? Or for example, a company, Hindustan Unilever Limited or a Procter and Gamble Limited, they may have a small factory which they have sold. They said, "Oh, we don't want this factory. You please, take this factory," and they've sold that factory, and maybe they've got a little bit of money. So all this is other income, right? Here we have taken a simple example of investment income, but there is a lot of other income that the business can also earn. And this income is usually not part of the standard, not part of the standard money making operations, right? These standard money making operations for any company like Hindustan Unilever is basically sale of all its shampoo, soap, ketchup, and or whatnot. This little thing is not a money that we can expect from the standard operation. So we should separate this from this, because this is telling us how efficiently the business is running, right? If we include the other income over here, then sometimes it may give us a wrong picture, right? So let's say, for example, what some company may do, it may sell a large piece of land. Company is owning some land. It has not made any factory there. It has sold a large piece of land, right? It acquired that land at, say, some small amount, and then let's say it has acquired that land. Let's just take a notional example. Let's say company has acquired that land as rupees 10 lakhs. Okay. But today that company is selling that land for rupees 5 crore. Now this company will actually report rupees 4.9 crore profit with the sale of the land, right? But its sale of its core product, the sale of its core product, which may be if the company is selling some soap and some shampoo, the sale of the core product has not changed by much. So we have to always look at its core sales to understand how the company is doing. These in other income just tell us what else the company has been doing. So for example, company has sold excess land, it got some extra income this year. Same way, there may be some other expenses, right? So for example, let us say some equipment, some heavy machinery, there was some accident and that all that heavy machinery got damaged. So that is and that heavy machinery cannot be used. So that is a one-time loss. Every day there will not be damage. Every day the heavy machinery will not get spoiled, right? It will not have some major accident. So those may be one-time loss that may happen to the business. Okay. So usually all businesses have some other income, some other expenses. Sometimes they will club both together and just say other income, which may have say the profit, the loss and everything. And they will just say this is say 30, right? 50 minus 20 is 30. They may also show it that way, but we should just understand the concept. Then after that, there is something called interest expense. So interest expense typically is for those companies which have taken a loan. So typically, just like we people, let's say I am working, okay, I am working in a company, and my salary is, let's just say for argument's sake, 50,000 a year, okay. But I had actually taken a loan of rupees 3 lakh, and every year I have to say every month I have to pay. Let's just take a notional amount of 10,000, just for discussion purpose. So my actual income, right, after paying off this loan, salary, loan payment per month. So my leftover amount is basically 40,000. So just as we have to calculate we calculate from our salary, okay, this is my salary, this is my loan, and I can, let's say this is my leftover amount, I can live with 40,000 a month, right? This is fine. Let's take another case. Let's say the loan is say 30 lakh. For example, the person has taken huge loan. For some reason, he is trying to buy a house. He wants to buy a house. He's taken a huge loan, but the person's salary is very low, right? And so the monthly loan payment actually comes to 1 lakh, and this person is actually in a loss of minus 50,000. So then this person becomes bankrupt. In the same way, companies which have an excessively high, which take very high loan, will have very high interest expense. And if those companies which take very high loan and which have very high interest expense, they typically go bankrupt, right? So interest expense is always calculated. We see, okay, this company has this much loan, have to pay this much amount, and that is always taken in the income statement. Okay. So then after the interest expense, we have earnings before taxes. So now how is this calculated? This is nothing but so what are the earnings here? This 50 is an earning and then 120 is a loss, right? So this will be equal to 750. Okay, we had 750 over here. This was the earning before interest and taxes plus this 50 that it has earned from his investment. And then we have to reduce these two amounts. These are losses. Some asset is lost, and then they have to pay interest expense also, right? We reduce all this and we get the same amount, which is 680. Okay. Now, finally, everyone has to pay taxes. It may be 25%, 20%, whatever. So a company has to pay taxes. And therefore, after paying taxes, we say this is the net income. Okay. So net income is nothing but this, the earning before tax minus this. Okay. So this is, so you may see if you go to different sites, you'll find a slight different variations of the income statement. So we are more concerned with understanding the logic of what is what. And this explains the basic logic of what is an income statement. An income statement is telling us for a period of time, right? For the year ending 31st March 2023. So what does this mean? This means from 1st April 2020 till 31st March 2023. For this full year, how much has this company sold? What is the cost of the goods? What is the gross profit? Right? What are the kind of expenses? And then what is the income that the company has? Right. Now, one of the things that we see is the margins, what are called the margins. So let us look at the actual income statement. So we have sales. So this is slightly different. Okay. We will not come to this today. I think we'll not have time. We'll continue in the next session, but we will talk about margins. So there is a business. This business has a profit margin of this by this into 100, right? So it's basically earning 19.2% profit. So what does this mean? It means on average, if the company has sold, let's say the company is selling a shampoo worth 100 rupees to you, right? On average, when this company sells that good of say 100 rupee worth to you, this company will make a profit of approximately 19.2 rupees on that 100 rupee. So approximately 80 rupee, 81 rupees is used for all the expenses, and then approximately 19 rupees is used for is the profit it gets. So this is the actual overall income statement that we as external investors are concerned with. Now within the company, right? Within the company, they have different divisions. They will have a soap manufacturing division. Okay, they will have a shampoo manufacturing division. So then the senior, the CEO may say, okay, how much profit is soap making? How much profit is shampoo making? Here we have looked at it as a whole. Okay, here we have looked at everything as a whole. But internally, when they take decisions, they will say, okay, how is this division doing? How is this division doing? So there is something called management accounting where they will expense the different, electricity expense, employee expense, all those sort of expenses are given at a division level. So even if there is one factory, in one factory, they may make multiple things. So for example, in one factory, they may make 2, 3 different types of soap, right? But they have a completely different accounting, which is internally used within organizations, where they will look at the profitability of each product. So even in soap, let's say we have some Lux, we have some Lifebuoy, I don't know the spelling. Anyway, we have some Lifebuoy, we have something else, and so on. So then we have some Dettol and so on, right? So they'll say, okay, this soap is giving me 15% profit. This soap is giving me, say, 10%. This soap is giving me, say, 40%, and so on. So typically, the premium products will be more profitable. So internally, companies have that, but we are not concerned with. We are concerned with it, but we don't calculate it, right? We will look at the overall company performance at the first stage, which is this income statement. Now, now I have given this a certain way. Now, you will find a lot of variations on a site-by-site basis if you go and open the annual income statement of any company. So let's just try and open one of the annual reports. Okay, some error. Let's try this. They will typically give the income statement in the annual report. I'm just trying to find out. Okay, this is some hierarchy. I think at the start it should be there. Purpose, value, our financial highlights, statutory reports, fast changing. Let's just take another simpler company. Let's just take Asian Paints, a very straightforward one. Otherwise, we'll just take a quarterly report.
Harish, you can see it in screener page itself. Don't
Hmm.
even need to open the quarterly report.
Yeah, no, we can
Like
see it in screener,
balance
but the
sheet,
way
income statement, it is there in the screener main page.
it is screener, it is there, but it's given a little differently in the actual document. So if you compare the screener with the actual document, it will always be
More
given a
detail.
little, yeah,
Yeah.
in more detail. So I think that's what we are trying to figure out. I'll keep one document ready for next time. But we'll typically have a statement in the structure that is given. 1 minute, let me figure it out. Journey about us, financial capital, human
Just
capital. I'll
control
keep
F,
one document ready.
search. Yeah, control F and income.
There are many terms. Okay, I think this one. What was this? Board report, financial. Okay, this is like a simple one, but we typically have a complex, large one presented where we will see there'll be many terms and it will be quite complex. This is a slightly simplified one, but we see here what is the revenue from operations, what are the other income, what are the total revenue. So the way we saw it here was we saw revenue and then we saw other income here. But over here, they are saying revenue from operations is here, other income is here. And then this is the total revenue. That's how they are looking at it. Right. But the only thing is this other income, maybe if it is one-off income, then it will show excessively high revenue. Like we saw that they have land. So if there is a land sale over here and they get very high other income, then this will show excessively high revenue. Right. So those sort of things we should just be careful. Then we have total expenses, then we have profits, and then we have, okay, exceptional items are nothing but one-off things, right? And then profit, what is the profit before tax, and then tax expense, profit after tax. So this is a simplified income statement. Typically, we'll have a more complex one. I'll just figure one out and keep it, and then we'll also compare it to what is actually shown in the screener, right? But we'll cover a few more things. So one of the key things we see over here is this. What are they looking at? Sales growth. So any business that we invest in typically should have good sales growth. Okay. When the sales growth is higher and assuming that the expense margin remains the same. So the profit growth also has to go up. So if we see this, sales growth every year is at a certain percentage, and then we will also calculate how much is the profit. So this is 5215 by 5066. Right. So this year profitability has not gone up by much. So sales has gone up by 8%, profit maybe only by around 2%. But then let's see this year. By what was the number? 5256, 5215. So this year it has gone up by about 21% and so on and so forth. And so that is what you see. Over, say, a period of 3 years, what is the sales growth? Over a period of 5 years, what is the profit growth? So let's take two examples, simple examples. No, Trent has some losses. We'll not take a company with loss. We'll take some straightforward examples of companies which are only giving us profits. Okay, let's take a simple company called Go Fashion. So now we see how long has this share price there? It's not there for long. Let's look at Safari Industries there. Now, if we come to Safari Industries, we see that the compounded sales growth in 10 years is 25% per year. I think we'll close it with this today. The compounded sales growth per year is 25%. So on average, the sales we see 160, 200, 270, 340, 400 and going on and on and on. And now it is 1550, right? So the sales is growing very fast. But let's look at Hindustan Unilever Limited, for example, and compare it. Hindustan Unilever sale, which is at 27,000 about 10 years back, has grown to some 61,000, right? Little over two times. Whereas Safari Industries has sales has gone up to from 160, it has gone almost up to 1600. It is 1550, so almost 10 times. Correct. Now let's look at the profitability. This profitability, which was almost at zero, right, has now there is now a profit of 176 crores. Whereas Hindustan Unilever Limited, which had a profit of 3,800, has gone up to about 10,000. So this has gone up to approximately, say, three times, not even three times, slightly less. Anyway, we'll say three times for argument purpose. And this has gone up by a huge amount, 170, 180%, right? Now let's look at the share price of both of these. Now, share price, I think screener is not available for 10 years, Safari Industries, but let's look at the share price here. So we see in 10 years, Safari Industries 10 years ago was at 80 rupees, right? Today that stock is 2,500 something, 2,470, 2,500 rupees. Whereas Hindustan Unilever Limited, the stock price was at 750 rupees and today it is at 3,000 rupees, right? So let's compare. Hindustan Unilever Limited is at 3,000 and it was at approximately 750, which is approximately four times. Whereas Safari Industries, which is at, let's say 2,500 for argument's sake, and this is at 80, right? So Safari Industries is at 2,500 by 80, which has gone up by some 30 times. So if you had invested 1 rupee in HUL some 10 years back, it would have become 4 rupees today. But if you had invested 1 rupee in Safari Industries approximately 10 years back, that would have come to 31 rupees today. And why is that? That is because Safari Industries is growing its sales very fast. It's growing its profitability very fast as compared to Hindustan Unilever Limited. And because it's growing its sale and profitability very fast, the stock price is also growing very fast. Stock price of Safari Industries in last 10 years has grown by approximately 40% a year. Whereas in Hindustan Unilever Limited, it has gone up by around 15% a year. So typically, when we look at the income statement, one of the key things that we should look at is growing sales, and then there is growing profitability. But there are several other things we'll talk about it in maybe in the next session, and then I'll also have some actual statement ready, and we'll compare some statements. We'll go through the screener income statement and so on, and look at it a little more in detail. Yeah. So I think at least from my side, I'm done. If we have any questions, we'll take the last 5 minutes for that.
Harish, I have one question. The sales that the company reports in quarterly, every quarter, is it the goods delivered or is it goods manufactured?
It is the sales that is actually done. So when you go and buy,
So,
you go to a shop and you buy, let's say, some suitcase. Okay. It is the sale that is done across all the shops where all the suitcases were sold in those 3 months. So if we look at a quarterly statement,
if there are some suitcases which are
we've only been
done
looking at annual. Mhm.
but not delivered, so it's basically inventory, right? My
Correct.
understanding is if you look at the cash flow, right, from the
Mhm.
cash that they get, the inventory they negate, they subtract. So I'm
Will not
assuming sales includes inventory.
sales does not include inventory. In
Okay.
COVID, there were Safari Industries which was selling suitcases or VIP industries. Their inventory went up because they could not sell. Had manufactured a lot of suitcases and kept, and then suddenly COVID hit. Everyone stopped traveling. So what could they do with those suitcases? They just kept it there, right? And so their inventory went up. So sales does not include inventory.
Okay.
Okay, any other questions? Okay, then thanks all. Have a nice week ahead. See you next week.
Yeah. Thank you, Harish.
Harish,
Yeah.